Hi, everyone. I'm Ben Swett, the managing editor of the SeniorCare Investor, and today I am joined by RJ DeBee, the senior managing director and seniors housing and healthcare practice leader at BBG Real Estate Services. BBG just came out or is about to come out with its annual investor survey. And in this fast-moving M&A market, we are always looking for the latest data points on where valuations are for seniors housing communities after perusing our senior care acquisition report, of course. But RJ, I'd love to get into the weeds of how investors' responses were different from last year's survey and then what that could mean for investors today.
Yeah.
So thank you for joining me today.
Yeah. Thanks for having me. No, we're excited about our survey. It's our fifth survey we've done since joining BBG. I think our biggest takeaways in this survey is how clean the data was. Historically, we've had a pretty wide divergence between, let's say, what lenders were thinking versus operators or brokers. This year, I think our data was the most clean and consistent that we've had. So I'm really excited to get into it and answer some questions.
Are you telling me that everyone is drinking the same demographics Kool-Aid now and just beyond optimistic?
I think that is a lot to do with it. We look at that forward-looking demographic curve. I think we're seeing a lot more people that were not traditionally in seniors get into the space
Yeah.
based solely on those demographic numbers. And so I think it's maybe somewhat of a self-fulfilling prophecy, but I do think that people are a lot more positive, and we're seeing the transaction volume and the cap rates to support it. So.
Yeah. Well, we'll jump into that in a second. Do you mind quickly describing the process of putting the survey together and maybe how your participant makeup was different this year compared to the previous year?
Yeah, it's a great question. So we try to get a pretty broad participant profile across a national viewpoint, right? And so that way we're not just looking at what owners think or what lenders think. We're trying to capture like a whole market perspective. So we send out an email to about 300 people initially, and then send up a couple follow-up emails based on where those participant profiles come in. We then do some selective outreach to make sure that we're filling out that data, and we're getting a good look and not just overly focused on, let's say, brokers or developers. Pretty similar profile makeup to previous surveys. Um, and I think the biggest, like I said, takeaway is that 97% positive outlook. We saw that throughout the participant profiles. And again, when we do these surveys, we like to look at what is the same across all of it and where do the responses diverge. And like I said, this year was more consistent than any of the previous surveys that we have done.
Well, I mean, speaking of the optimism, you had 93% of respondents think that we were going to see higher transaction volume in 2026 compared with 2025, which, you know, yeah, it makes sense, but last year was a record by far just in terms of transaction activity. And we
Right.
know that the buyer interest is out there, but are there going to be enough sellers to make that happen?
I think that is what will determine what 2026 is. We obviously see a premium for those Class A core stabilized property types. We're seeing that in real world too, right? On the appraisals that we're working on, when we talk to the brokers that are listing these assets, we are back to double-digit offers, several rounds of best and final, all things that we think that are indicative of a healthy market. Historically, what we did not see was that same level, or at least any interest in that value add, non-stabilized stuff that's coming out of COVID that has a story. And I
Yeah.
think that we're starting to see buyers be a little bit more aggressive on that. I think it all is determinant on confidence of NOI and underwriting. But
Mhm.
now that we're seeing lenders come back, I do think that there is more of an opportunity for those sellers to bring something to the market where it's not, so one-sided like it was in the last couple of years.
Yeah, I've been waiting to see because you're right, prices and cap rates moved so quickly and so much for the Class A stabilized stuff. And I was curious when at some point, maybe in 26 or 27, enough buyers would just be forced to go to the value add, Class B, Class C communities just for the sake of basis and affordability and having any kind of return. So do you think sellers of all property qualities are going to be able to go to market from a position of strength in 2026, or is it still going to be a buyer's market in some spots?
Yeah, I think 2026 is really going to be a tale of two different markets, right? We see that premium pricing for the stabilized, the value add stuff, or, we're seeing a lot of these properties that even are not that old, but because of pressures through COVID and after, have not had the same level of CapEx that has gone through these facilities. And so you may have an 8-year-old, 10-year-old facility, but it looks like it's a 15-year-old facility, right? And I think our
Mhm.
buyers are doing a much better job during underwriting of trying to determine that impact on their forward-looking cash flow. We are doing a lot of assessment reports at BBG on those properties to really dig in and figure out what is the physical plant like and how is that going to impact us moving forward. And so I think that is a big component. But I do think with the return of the debt markets, there are more options for these, where prior to that, it was really predatory pricing for a lot of these buyers on those non-stabilized properties. So again, I think when we don't have any development, at some point, people need value add opportunities. And with ground up development being so difficult currently, I think that these, provide an option for some of those buyers.
Yeah. Let's go back to the survey. Which property type saw the biggest compression in cap rates according to your respondents? And then did you agree with that?
Yeah, so it was pretty consistent across the board. I mean, we'll say 50 basis points from last year's survey. Some of those were closer to 35 basis points, some of them were closer to 60, but kind of all over, looking at all markets, all care levels, about 50 basis points is kind of the good broad strokes answer. I
Yeah.
think where we have seen cap rates continue to match what we are seeing in the transaction market is those lower acuity, less operational intensive properties, active adult, independent living. We're also capturing that first wave of baby boomers turning 80. And so when you think about the property types that are most likely to receive the benefit of that demographic wave, it's those
Hmm.
lower acuity ones that we're really seeing improve. Again, I think that is a really good sign for our industry as far as what is to come.
Yeah.
And I've heard a lot of our clients talk about, I think, saying that they think that people will look back at 2026 and wish they would have bought more 2 years
Mm.
from now. And so, yeah, I think it's an interesting sentiment. It's probably what's leading to the positivity of the survey results.
Yeah. What do you think contributed the most to that cap rate compression, just according to the results? Do you think it was interest rates? Was it buyer demand or lessened perceived risk of those assets?
Sure. I certainly think interest rates has to be a part of it. But I think that what we keep hearing is cap rates matching underwriting, right? And the confidence that buyers will be able to obtain that underwritten NOI. And I think that when you look at active adult and independent living, they're less operationally intensive. I just think that there's more confidence that they will be able to purchase it and then operate it as underwritten moving forward. They're less impacted by some of the inflationary pressures, by some of the care components, any kind of like regulation changes. And so I think it makes sense that we're seeing that be the lowest cap rates and the ones that compress
Yeah.
the most as we've gotten back into a more normal lending environment.
Yeah. I mean, looking at the results, but also some deals you may have seen in the market, do you think there are any cap rates for any particular property types that are just too low today?
Yeah, I think that we talk about cap rates all the time, that these are not just real estate, right? We are appraising a business and the real estate all together. And our survey is meant to reflect that going concern cap rate. And so I think certainly as we get into that more operationally intensive property types, we always question where those cap rates are and how aggressive it is. I think we are close to where cap rates should be. We're certainly not as aggressive as we were at the height of the market back in 2021, 2022. We certainly aren't nearly as pessimistic as we were 24 months ago. And so I think that we're kind of in a good spot where with rates are and where cap rates are, there's still leverage and opportunities for deals to get done. The one property type that we do see the most interest in is that continuum of care, something that's
Yeah.
got the appropriate amount of IL, AL memory care units. And we see those tend to trade at a lower cap rate than I think the weighted average would determine based on our survey results,
Mhm.
if you just broke it down into what those average cap rates would be for each component.
Do you think that that is because those continuum communities may have a larger share of aisle units than they may have had in the past, or is it because of more intense buyer demand in that particular submarket?
Great question. Look, I think it's certainly we are seeing those have much larger IL components and sometimes cottage components, sometimes more of the apartment style that can grab that active adult. I think that developers and investors are getting smarter as far as what the market is requiring. And so I think having that larger IL component, obviously there's a self-feeding component to those higher levels of care. And I do think from a prospective resident, that's a positive option for them to move in, and it's a one-time move, right? And they know that someone is there to watch, and that when mom and dad require that additional level of care, somebody's there, they're watching for it, and they've got an option for them to move in directly.
Yep.
I think that that helps with stickier residents. We see turnover be less there. We typically see occupancies be higher in those communities. And so I think when you factor that all in together, that allows a buyer to come in and be a little more aggressive on a cap rate.
Mhm.
Again, because I think that they're looking at confidence and NOI and how that's going to impact that future underwriting.
Yeah, makes sense. Well, I mean, just kind of speaking of confidence and optimism, the survey results were also very glowing for rental rate growth and in kind of what stabilized occupancy is. So, what did you learn from those results in the survey? Do you think stabilized occupancy should increase next year, or what is considered to be stabilized occupancy?
Yeah, I think that stabilized occupancy has been something we've been chasing for the last couple of years, right? And I think what we are seeing not only in our survey results, but in a lot of the appraisals that we are doing for REITs and others, where we're kind of now into that full budget season where we've got a really good real-time look at what 26 budgets are. Stabilized occupancy underwriting is certainly increasing. We're seeing it across the appraisals we get, the pro formas that we get, the few development deals that we are working on. We are seeing those occupancy numbers, especially for IL, creep back up into that mid 90s, where it felt like for a long time everything was just 88 to 90%, and that was where we were underwriting. We're certainly see that creep back up again.
Like to 93, 94, maybe even 95%?
Especially on those lower acuity sides, right?
Yeah.
94 for IL and then maybe 90 for AL memory care. But if the IL component is making up, 50 to 60% of your community,
Yeah.
that weighted average is 92, 93%. That is something that's certainly higher than what we saw the last couple years during this same round of budget season.
Mhm.
And compared to prior surveys, that's certainly much more aggressive and confident in that stabilized occupancy number.
Yeah. And do you think seniors housing operators are going to have a similar kind of position of strength when it comes to ability to increase rents for residents in 26 as compared to 25?
Yeah, I think that's it, right? When we see occupancy continue to creep up like that, the first lever we see people pull is starting to increase those rental rates. We've seen record rental rate growth over the last several years. It matches, Nick's data of, I think it's 18 quarters in a row of increased occupancy. We are seeing that rental rate data, especially in those like core assets, those nicer, newer properties. That rental rate growth we are seeing actually proved out in the rent rolls that we review.
Hmm.
Where I think there is a bifurcation in the market is those like 2000 vintage or 2010 vintage. We're not seeing the rental rate growth get pushed quite as high.
Yeah.
Occupancy is still there, and I think it's a great sign of a market that's returning and becoming more healthy. But the 6, 8, 10% year over year rent growth, I think at some point we run into an affordability factor, and
Yeah.
I'm not sure that's sustainable long term. But until we get more development and more units on the ground, I think that there is going to be a continued impact on occupancy and rental rates.
Yeah. I mean, well, it sounds like that's going to support these, kind of record high prices that we're seeing in some core class A assets out there if they're able to keep growing their revenues that way.
Correct. Yeah,
Mhm.
correct. Again, I think it's confidence on NOI.
Mhm.
And the more of a story you have to tell with trailing rental rate growth and occupancy, I think the greater impact that has on pricing.
Yeah. Well, in the survey, was there anything that you surprised you the most, or maybe that you disagreed with the most in the results?
I think for us, anytime we get that consistent of a data from all the participant profiles, I think that's always the one that is a little bit shocking. We expect to see
Yeah.
some noise in the data, and we certainly expect to see, let's say, a lender's outlook be different than a developer's or a broker's, right? Um, so for it to be as consistent as it was, I think that's a positive thing. Hopefully, that means that bid-ask spread, the market is kind of back to somewhat of an equilibrium on pricing. And I think that probably is what leads to a lot of the survey responses saying that they expect volume to be higher this year than last year. I think it's
Hmm.
because most people are just more consistent on expectations this year. The one thing that did pop out was I think 74% said availability of debt was their biggest concern. That was interesting to me. We just haven't seen, I really feel like since really summer of last year, debt markets and deals with banks have really come back around. And
Yeah.
so we haven't seen that pressure that we did, let's say, 2 years ago when the debt
Mhm.
markets weren't as available. So that was
Hmm.
interesting, but no, of note, anytime we get that much consistent data together, it's great for the survey, but yeah, we definitely went back and checked a few things to make sure we weren't
Yeah.
missing something.
Huh. Well, I'll tell you that that's something I'll personally investigate at Nick next week
Yep,
then.
for sure.
Well, what do you think was the most important results for prospective buyers and sellers going forward?
Yeah, I think for us as an industry, I think the continued improvement quarter over quarter as we've come out of COVID and then really even looking back to 2023, we've kind of had this like nice trajectory of like we've had more volume and things have improved 2023 to 24 to 25. And I think that is the outlook for 2026 is that we continue that upward growth. Probably driven by like what we've talked about, rental rates and occupancy. And then the lack of development leads to all of these opportunities in 2026. Again, I think there'll be a lot of people that look back and wish they would have bought more this year.
Mhm.
But I think the biggest question as we go into the year is what do we do on those non-stabilized deals and how aggressive are buyers going to be? And what kind of position of strength will the sellers have when they come to market?
Yeah. I mean, it's been very confusing on our end just how those kind of value add Class B assets have been valued because you'll see a price of 240,000 a unit and think, "Oh, yeah, that makes sense." And then you'll see kind of a comparable community that's 120,000 a unit, and you're like, "Oh, okay, yeah, I guess that makes sense too." I've seen a much wider berth in how those have been valued, so I'll be following that very closely.
Yeah, I think it's in the details in the story. I mean, we hear it all the time, right? Is it an operator problem? Is it a
Yeah.
market problem? Is this something that that new buyer thinks they can fix? And how quickly can they fix it? Again, and I know I keep saying it, but the confidence in NOI and that what that forward-looking NOI is, I think, is really the determinant of the pricing power for those properties.
Yeah. Well, this video is going to be coming out, right as everyone's arriving in Nashville for the Nick conference. So, RJ, I kind of want you to set the tone for the conference and everyone who's watching this right before they head into all their meetings. What do you think the buzz is going to be centered around in Nashville?
I think transaction volume and that return of portfolio deals, I think that is something we're really watching. We find that to be very indicative of a healthy market when we get back to those multi-property transactions. We saw a lot more of those in Q4. It's something that we are tracking and seeing a lot of this year. We've obviously had several big acquisitions so far in Q1. And so I think that is part of the buzz, hopefully the positivity. And then the question I have for everyone is that what does development do and when do we get back to building?
Yeah.
On our end, through market studies and those construction deal appraisals, have started to see some, but certainly not enough to make an impact on what we see as this pending demographic wave. And so That's something I will be asking everyone as we go through, that there's so much positivity and that's great, but at some point, those rental rates and occupancy should justify development. And when do we start that again?
Yeah. Well, I'll be sure to grab you at the end of the conference to see how all those
Yeah.
conversations went, because you'll know before anyone else whether development's coming back.
Yeah.
Well, RJ, I appreciate the time. We'll of course do this again next year for your sixth investor survey, but thank you so much for joining me today, and congrats on the survey, and hope it's very well received. But I'll see you in Nashville.
Yeah. Sounds great, Ben. Appreciate it. And thanks to our marketing department, everybody that filled it out, our research director, Garrett Watson, couldn't do it without him. And obviously appreciate you having me on and giving us the opportunity to share the results. So looking forward to having everybody hear them about it at NIC conference, and I'll see you in Nashville.
See you then.
Thanks, Ben.